Investors are keeping a careful eye on the health of the global financial system. That is, central banks take coordinated action to try to calm markets. And UBS agreed to buy troubled lender Credit Suisse. A lot going on. Joining us now for his view on how to think about it all, Michael Craig, head of asset allocation at TD Asset Management. Michael, great to have you back with us.
Glad to be here.
All right, so Friday's not the end of it anymore these days. You go home on Friday, you read the weekend headlines, and you come back on Monday into the thick of it. What do we make of what's transpired in the past couple of days?
Oh, pretty historic. 15 years ago it was Bear Stearns. Right around the same time, this week it's Credit Suisse. It takes away some anxiety in the market. Obviously, Credit Suisse was coming off pretty hard last week, and this will give us probably some time for a breath. But the overlying issues that we're going into this still remain, and so we expect to see. This is certainly, it was probably the end of the beginning, or the beginning of the end, if you think about where we're going from here.
All right, so basically what we're talking about is the global financial system, the concerns. I mean, it seems like a million years ago. Silicon Valley Bank, what was it, a week and a half ago? That had failed, and then of course all the pressure on the U.S. regionals, wondering what the exposures of the bigger banks. You get this event where UBS steps in and buys Credit Suisse. You're saying sort of early innings. What do we need to be watching for as investors going forward?
Credit. I think in terms of credit availability, banks pulling back. There is data from the Fed weekly that does show assets and liabilities across the U.S. banking system, and we'll be watching for that to start to contract as banks start to pull away. The reasons for each of these failures have been very different. Silicon Valley Bank basically doing their best impression of Orange County back in the 90s. I mean, this is not an original way to blow up a bank. You had a bunch of deposits and they put in longer term investments, and that went against them. And then with Credit Suisse, they've been kind of bumping into sharp objects now for some time. They've been in the press for, any kind of mistake that's happened, it seems that they've been tied to it. So these weren't high quality business models, if you will. But we're coming back. Fed, as you mentioned, we got a rate decision this week, and the Fed's in a tough spot they've got this newfound problem with financial stability, but they still have an inflation problem. And so, they'll have to choose in terms of what they're going to focus on. My sense is it'll be on the inflation side.
On the inflation side, right? Because there's no shortage of punditry out there right now as to what the Fed might do only 2 days from now. And there's a school of thought that thinks, okay, they're still probably going to raise maybe 25 basis points to show that the fight for inflation is an important one. And then if they didn't raise, then maybe they're a little more concerned with the global financial system. They want to let them show their hand to be. It's hard to make sense of it with only 2 days to go as to exactly what they'll say and what, more importantly, they might have to say about just the health of the global financial system.
Yeah, for us, it's to try and first predict what they're going to do and think, and then actually earn a return off it is next to impossible. You need to think about what the range of probabilities are and then the expected reaction. I would say that if they do come in and hold and not do anything, that's probably going to create more damage than not. We're in the midst of, because if the market starts to believe that they're going to lose their kind of zeal against inflation, then we could see a repricing of inflation expectations, and that's way more problematic in the long term. So I would expect them to go 25, and it continues to, you can't, this belief that you can kind of bring inflation down, it's not like we can just dial unemployment to a perfect level and consumption to a perfect level and not create distortions. We have to. The cost of dealing with inflation is likely a recession. And so I think that they'll have to stay the course until they see evidence of a real turn in inflation. And so I think if we actually just forget about the recent banking stress, it's still stay the course in terms of a hiking cycle and more corporate failure, as companies just aren't. A lot of companies are just not set up to operate in an environment of tighter financial conditions.
You talked about what was particular to Silicon Valley Bank and the sort of strategy that they had that went against them. Credit Suisse, long before all this happened, you just said there was no shortage of headlines about surrounding that bank. Would the Fed take that into consideration, you think, and say these are specific incidents that are specific to the circumstances there, or is there a broader read for everything that's happening right now?
Well, they're definitely going to be concerned about the performance of the regionals. And the regionals have a different compliance regime than the money centers. And so there is risk. Those business models aren't as diversified. They tend to be focused on their geographic region. There are 6,000 banks in the US, remember. So it's like, imagine, the equivalent in Canada would be having 60 banks. So it's a system that's always going to have some degree of bank failure because you've got so many that it's hard, you're going to have some that make mistakes. But their mandate is inflation. And so I just don't think they can step away from this and not worry about that when we still have. And core has been stubborn of late. And so until you see a real backup in unemployment, they're going to stay the course. I don't think that terminal rate is probably as high as it was a few weeks ago. But the way the market is behaving right now, it's, like I said, the short end is trading like a penny stock as expectations whip around. Look, we might be back to 5.5% terminal in no time if we get another hot inflation reading. So I think that's what they're probably terrified of, and why I think that it would be a foolish mistake to go less than 25 this meeting, only because I think it would signal that they are panicking.
I don't want to go too deep into the weeds on this one unless you want to give us a master class in how all this US dollar liquidity swaps and all these markets and windows work. But there was that notice from the central banks over the weekend saying, this group of Western central banks is going to, make sure that we take some action to preserve US dollar liquidity. How important of an event is that?
So what it does tell you is I think they are separating hiking and inflation on one hand and financial stability on the other. This is all about financial stability. This is all about providing liquidity to banks so they can continue to operate. And so I think in seeing that, it does tell you that they're not going to use interest rates as a way to quell this stress. They're going to use other tools. And so investors, again, if you're an investor and you're hoping because your investments are perhaps set up for lower interest rates, I think you need to be concerned because I don't think you're going to see that. The funny thing is, like last week, the market was pricing another hike and then 4 cuts until January next year. And I don't think that's going to happen. I wouldn't say there's no chance, but I think what it's telling you, the average doesn't make sense, but it's the inputs in that average that are quite interesting, and that would be that there is, let's say, 80% of no cuts this year, and a 20% chance you get like 400 basis points of cutting, which is actually typical of an interest rate cutting cycle. If we get 400 basis points, we're in a hard landing. Like that's
we talked about it before, right? Yeah. If your bet is that you're going to get lower rates, it's because something very bad has happened.
Yeah, it's a hard landing, and we're talking about 6 million Americans out of work, or 7 million, a couple percent higher in unemployment. So that's kind of the realm of probabilities now that the market's looking at. We probably don't see that, 8%, although that's moving around, but there is now. And so that, when you think about base case recession, but now there is that increasing risk of a credit crunch because, credit conditions are going to tighten based on all the stress in the regionals. So, look, March is always a funny month. It's like March and September is almost like I remember them like my children's birthdays. And once again, March has come and delivered. And I think it's important to just be mindful that the range of probabilities are probably more now to the bearish side than were a month ago.